Hello and welcome to the Scan the Markets live webinar with myself, David Madden. I work as a market analyst for Equity Capital in London, and Equity Capital is one of the many groups, one of the many companies within the overall equity group, which of course contains various entities, including Equity Nigeria in Nigeria and also FX Pesa in Kenya. So for those of you who've not viewed or attended one of these live updates before, what I'll quickly do is I'll run through about five major markets, major markets, and run through what's been going on from a fundamentals point of view in terms of news, and also what's important in terms of technical analysis, the study of charts, and looking at potential areas, looking at potential price areas, looking at prices that might be potentially of importance. So the first chart here I'm looking at is gold. Before I kind of proceed on the gold chart, I just want to point out, if anyone has any questions for me about what I'm covering then and there at the time, feel free to ask questions towards the end of the update. I'll then kind of throw it open to any questions or any charts that I haven't covered. Feel free to shout that out. But please, for the time being, please kind of refrain from holding questions until I'm actually, unless, of course, it's related to the topic then and there. Otherwise, please, if you allow it till the end. In terms of the charts I'm looking at the chart here of gold. The time frame I'm looking at here is a 4-hour chart. I've been looking at 4-hour charts across the board for all the charts, and the time frames that I have here is a 20-period moving average, a 50-period moving average, and a 100-period moving average. So looking here at the price of gold, we can see gold has been in a clear example of a downward trend, a series of lower lows and lower highs. In fact, we've recently seen gold fall back to a level last seen in mid-February. So we're back to 3-month lows on gold. It's in a downward trend. It's even in the last few minutes, it's at a new 3-month low. That really kind of highlights how bearish the move in gold has been. Looking here at the MACD indicator, we can see that momentum has swung from positive territory to negative territory, indicating that the bears are now in control. Looking at the RSI, it's the relative strength index, that's moving aggressively lower, also indicating that the price bias is to the upside. Sorry, upside indicating that the price bias is to the downside. If gold continues to hold below these 3 simple moving averages, it's likely the recent bearish trend will continue. Moving lower from here, we could look to retest 1820. We're not too far away at the moment. We're currently at 1823. We could retest 1820, and a break below that could see us back down towards 1792. Now, if we do see any kind of correction or rebounds of gold, it is a possibility that it could happen. Let's face it, if you look here at the RSI, it was in oversold territory in late April, and that preceded this sharp snapback in gold. Now, just because a market moves into oversold territory, there's no guarantee there will be a snapback. It happens from time to time, but not always. We can see here on the RSI, it's very close to, it's ever so slightly in oversold territory at the moment. So if it continues to move further into oversold territory, that could act as a bit of a warning light to say a snapback may or may not be in the offing. If you do see a rebound in gold from here in terms of price-wise, where could we go? Well, I'm looking up towards this peak here in around 1865, and then beyond that, I'll be looking up towards this. This peak here at 1892. Because although we have been in an aggressive downward trend in the last few weeks, it's worth noting we have seen a couple of relatively large snapbacks, such as here, and also here. So keep an eye out on gold. Now, what's been driving gold recently? Well, there's a few things going on. First and foremost is the strong US dollar. Gold, like other major commodities, is traded in dollars. So whenever the US dollar is strong, it tends to hurt gold. Why is this? Because if you have Eurozone euros or pounds in the UK or indeed the Canadian dollar, and you want to get your hands on gold, you first have to get your hands on the US dollar. And if the US dollar is relatively strong, which it is, it's essentially at a 5-year high. If the US dollar is strong, therefore your euros converted into, for example, your euros converted into gold buys fewer dollars and therefore becomes more expensive to buy. Conversely, if you look at the two charts, and over the last few years, and you see periods where the US dollar is quite weak, you typically see an upward move in gold, because when you're converting your British pounds, for example, into US dollars with the intention of buying gold, the conversion rate from British pounds into US dollars gives you more US dollars because of the favorable exchange rate, and therefore you can buy more gold. That's one of the issues of what's going on. What's also being at play is actually fears of recession. You know, in the United States, for example, the economy contracted by 1.4% in the first quarter of this year. Although there are some, there's some questions being asked about those figures, saying it's more to do with a trade deficit, it's more to do with a trade issue rather than actually a recession issue, a growth issue. There's also kind of concerns that the global economy is slowing down. We've already heard from the last few weeks from both the World Bank and the IMF that they've downgraded their growth forecast for the global economy. Only last week we heard from the Bank of England, who stated that they predict the UK economy will contract next year. So all this kind of negative headlines about slowing growth, negative growth, could we enter into a recession? Because several countries enter a recession, or we could have a global recession or a global slowdown. These factors are all we can do. They're in the rounds. With that feeds into the idea of why we have a strong US dollar. Now, typically gold performs well whenever stock markets fall, but at the moment, the reason why stock markets are falling is because of higher interest rates in the United States, and the higher interest rates in the United States is pushing up the dollar. So, as the United States has higher interest rates as of last week, that is going to accelerate the fears about a recession, and that's kind of pushed when people are taking money out of stocks. They seem to be more recently pouring money into gold, into the US dollar, which ties in with the risk-off attitude. People are, equities are deemed to be relatively higher risk compared to, say, government bonds or cash in the bank, or historically gold has been a good popular risk-off play. Whereas more recently, we're seeing that the US dollar is going to capture more of that portion of the market. Why is this? Well, the United States, the central bank, the Federal Reserve, hiked interest rates by 50 basis points last week. There's already kind of talk that more further interest rate hikes are on the way. There's even some speculation out there, a kind of minority of market participants believe we could have one or two more 50 basis point hikes. So people are thinking to themselves, in an environment where it looks as if interest rates are going to continue to rise, I might want to be holding my cash in an asset that bears interest, be it a government bond or be it a cash bank account. Gold doesn't bear interest, so that's one of the issues that's working against gold in this current environment. Looking now at the euro dollar, I mentioned a moment ago how the US dollar itself is at its highest level in about 5 years. Conversely, euro dollar has fallen to its lowest level in about 5 years. So the strong dollar here is the direct driving factor behind that. What's been behind the strong dollar? Well, last week we heard from the Federal Reserve, the US Central Bank, and they hiked interest rates by 50 basis points. They gave the impression that more interest rate hikes are in the pipeline, which wasn't a surprise. But now traders are asking themselves, the next time that the Fed of interest rate decision, or the next time they do raise interest rates, is it going to be, the question isn't going to be, are they going to raise rates or not? The question will be, how much do they raise rates by? Will it be a 50 basis point hike like we saw last week, or they revert back to, the quote unquote, the more usual size of movements of 25 basis points? So hawkish Fed is kind of talk of a hawkish Fed has been doing the rounds recently. That being said, we've also heard in a very kind of minority of European central bank bankers, policymakers, a couple of those have been calling for interest rates for the ECB, the European Central Bank, to hike rates in July. I don't think they're necessarily going to do it anytime soon. They probably won't do it as soon as July. I'd imagine that they're probably going to wait and see what the growth figures come in and look like. Although inflation in the Eurozone is at a record high, keep in mind the Eurozone itself has only been around since 2001, so just over 21 years on the go. But the very fact that a couple of central bankers are calling for an interest rate hike, this could be the beginning of the kind of the foundation, if you will, of the talk of hikes. A couple of policymakers called for hikes in July, which could easily kind of set the scene for an actual hike in, say, September, for example. That being said, we can see that the US dollar continues to dominate. The fact that we fallen to yet another new 5-year low in the last few hours really speaks to how bearish euro dollar is. Looking here at the MACD indicator, we can see that there's a steady increase in negative momentum. So that tells us that not only are the bears in control, they're actually gaining influence. The RSI has moved sharply lower. In fact, it's moved into oversold territory. So, while euro dollar continues to hold below these three simple moving averages, it's likely the short-term bearish trend will continue. Moving lower from here, we could be looking at targeting 1.03, 1.02, and then parity, 1.01, euro, 1 euro gets you exactly $1. That'll be the big level to watch out for. Whether we actually go to parity or not, I don't think we're heading in that direction just yet, because I think at some point, some people will realize perhaps we could see further calls for the ECB to hike interest rates. But that being said, the upward move in the US dollar has been pretty impressive. And it sounds odd, but if you're going to be trading euro dollar or any US dollar crosses, I will keep an eye on what's going on with global stock markets, because recently it's almost like every time the global stock markets falls through the floor, which is been happening a lot lately, the US dollar seems to move higher and higher aggressively. So it seems to me as if the US dollar is benefiting greatly from the fact that stock markets are falling. So if you are trading euro dollar, I will keep an eye on what's going on with stock markets. So, in terms of price action, if we do see a snapback in euro dollar, where can we go? Well, I've been looking toward this moving average here, the 50-period moving average. Once again, this is a 4-hour chart that I'm looking at, and the 50-period moving average comes into play around 1.0547, and a break above that, you can see a target this peak here, the peak of early May, and at 1.0641. You can see here that we've now moved into oversold territory on the RSI, so that could be an early warning sign to say that if a snapback is in the offing. We can see here we move aggressively into oversold territory here in late April. This is when the most recent 5-year low was set. The market moved aggressively lower. We moved further and further into oversold territory, and then the market snapped back. Now, as you can see, the snapback in the grand scheme of things wasn't that big. It didn't really last very long. So who knows? We may or may not see something similar, but we can see already with this candle here, this yellow body, we do appear to be off our recent lows already. A moment ago, I talked about how we had an aggressive sell-off in stock markets around the world, particularly in the US. And looking here at the US 500, we've now fallen back to levels last seen, I think it was 15 months ago. So back to levels 14 or February 2021. So we're talking back to levels last seen in March of last year. So we're talking 14-month lows being set on the US 500, which is which if you think about it, is actually quite remarkable, considering it was in basically the end of the year. We were setting new all-time highs into December last year at the very end of the year, and even the rally that we saw in late-ish March, early April was a multi-month high. So it goes to show you how sentiment has quickly changed. Once again, it's a classic definition of a downward trend, a series of lower lows and lower highs all the way along. And now we've actually recently fallen to a new 14-month low. So the fact that we're now hitting a new, lowest level in over 1 year really kind of highlights how bearish sentiment is. We have had a bit of a snapback. We're off the recent lows. But that being said, we haven't even retested the 20-period moving average. So any kind of moves to the upside and rebounds we've seen have been fairly limited so far, anyways. The MACD indicator shows that momentum is firmly in negative territory, once again suggesting the bears are in control. The RSI, it's no longer in oversold territory, but it's quite near oversold territory. It was briefly in it, and it's kind of managed to kind of turn around. Ultimately, while the US 500 continues to hold below all three moving averages, it's likely the more medium, the kind of longer term bearish trend will continue. A move lower from here could see it retest 38.76, and a move below that could see it down towards 38.60, and then go below that down towards 38.50. These are kind of the levels to watch out for to the downside. Essentially, we have quite a strong rebound here at a zoom in here. You can see that this candle here, that has a long wick on it. This yellow line that you see here, that's that long and that long line here is what you call in technical analysis the wick. It's quite a long wick in the candle denotes indecision. Not to say that every time there's indecision in a market, you're automatically going to have a bounce back, but sometimes you can have a bounce back. So if you do have a bounce back in the US 500 from here, where could we go? Well, we could target this peak here in around 40.69, and a break above that could see a target this simple moving average here, which comes into play at 41.67. You can see here, if you follow this moving average along here, you can see that it acted as resistance here. So, so the metric has acted as a barrier to a rally previously, a resistance zone previously. So there's a possibility we could have another barrier to resistance again. Why is this going on? Well, first and foremost, we have a hawkish update from the Federal Reserve. So we've already had a large interest rate hike from the Federal Reserve last week. Therefore, the cost of borrowing goes up. Therefore, all the companies that are in the S&P 500, pretty much all of them, will have certain levels of debt, some more than others. And if the central bank hikes interest rates, that means higher borrowing costs for everyone. And with that, companies that have, particularly companies that have high levels of debt, they're going to be hit the hardest. And the tech sector, traditionally speaking, has high levels of debt compared to a traditional sector such as retail, for example, or even banking. So we have had some very aggressive moves to the downside in some tech stocks in the last few weeks and months, even some big name tech stocks. And with that, because there's such a large constituents of the S&P 500, we have seen the S&P 500 underperform when compared to, say, the more traditional market or the more traditional index, such as the Dow Jones. What's also been going on is fears of a recession, not necessarily for the US, but just also for the wider economy or slower growth. As I mentioned a few minutes ago, in the first quarter of 2022, the US economy contracted by 1.4%. That in itself is a bit of a worry, although, like I mentioned, some people are questioning those figures, saying, well, there were trade issues, so it could be worse to do with that than anything else. But nonetheless, any of the services or manufacturing or construction numbers that we've seen suggest at least the US economy isn't as strong as it was. So it does appear to be cooling down. And these are all factors behind the US 500 decline. One of the major beneficiaries of the sharp downward move in global stock markets has been the Japanese yen. What we've heard from the Japanese yen is that the Japanese yen has a track record of being a flight to quality asset. In that, what that means is whenever traders are fearful about the health of the global economy and they want to close out their positions in assets that are considered to be riskier, such as stocks or metals, what they end up doing is they end up buying assets that are deemed to be lower risk. And the Japanese yen, the Swiss franc, gold historically has been in that situation as well. Not so much recently, because the US dollar has become a bit of a flight to quality, and the strong dollar has hurt gold. But the Japanese yen has performed well in today's session. Has had a very impressive run. So you can see here that the Japanese yen was very weak. It was only a few days ago, dollar yen hit a new 7-year high. So therefore, the US dollar was at a 7-year high versus the Japanese yen, or to put it another way around, the Japanese yen was at a 7-year low against the US dollar. So we had a scenario only a few days ago where the Japanese yen was extremely weak. And in the last couple of weeks, we've seen the Japanese yen hit a multi-year low versus a raft of currencies: the Australian dollar, the Canadian dollar, the euro, the British pound. So there was weakness in the Japanese yen across the board. So it's not surprising to find out that when the market has taken such a hard hit, some bargain hunters can't enter the fold, and they combine that with the fact that stock markets, in Europe and the US are losing 1-2% in a day on a fairly regular basis. People are then going, you know what? I went out of stocks. I want to put my funds into low risk assets and enter. This is where the Japanese yen comes into play. So this currency pair here is the US dollar versus the Japanese yen. We have heard hawkish commentary from the Federal Reserve, but the problem is the hawkish commentary from the Federal Reserve is a major player, is a major reason why stock markets are falling. And when stock markets are falling, that's why the yen has been driven in demand. Once again, fears of recession in various countries around the world, or at the very least, the concerns that the economies are slowing down, which may or may not lead to recession, and then also the strong yen. So what we can see here on this currency pair, USD JPY, with this is the US dollar in terms of the Japanese yen. So you can see here that the US dollar is moving aggressively lower against the Japanese yen, even though today the US dollar is quite strong, but it still lost a lot of ground versus the Japanese yen because the yen is so strong. And this is all to do with the fact that traders are in risk-off mode. They're selling stocks and they're looking to pour the funds into safe haven assets. So I can't ignore the fact that only a few days ago we had a 7-year high. So the really long-term trend for dollar yen is still higher. But at least in the short term, while we continue to hold below these 3 simple moving averages, it's likely the recent downward trend will continue. I'll move lower from here. Could see it back down towards this low here, the lows of late April in a 126.93, and a break below that could see us back down towards this low here, the low here of mid-April in around 1.2509. Like I said, you can't really ignore the fact that we had a 7-year high only a few days ago. So the big picture trend for dollar yen is the upside. If you are going to be trading any Japanese yen cross, I would pay attention. I would have a look at what's going on in stock markets. What we may or may not see in the next few days is stock markets turning around. And if you see stock markets turning around, that's going to put downward pressure on the Japanese yen and therefore potentially lift dollar yen. So if we do see continuation of the broader upward trend in dollar yen, where can we go? Well, I've been looking up towards this moving average here, the 50-period moving average. It acted as nicely as support here, 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 and here, and then even resistance here. So this metric, if you follow it around, has acted as both support and resistance on quite a few occasions, in the past month. And what I often say is, if a metric has been of importance in the past, be it a moving average or a support or a trend line or a resistance zone or a support area, if a metric has been of importance in the past, it's more likely to be of importance in the future, although there are no guarantees. So if we do rally from here, we could target this moving average here, which comes into play in around 129.81, and a break above that could see a target this zone here, this peak here at 131.34. Coming on now to the British pound. So once again, the strong US dollar has been a theme of today's session, and in turn today's webinar. We've had the strong US dollar. We've had a broad, by and large, a risk-off attitude. So people want less risk, not more risk-off attitude. With that, some funds have been poured into the US dollar because of the risk-off sentiment. Only last week we heard from the Bank of England, who cautioned the UK economy might contract by 0.25% next year. Today we heard from the Bank of England, we heard from the Office of National Statistics, who stated that the UK economy actually contracted by 0.1% in the month of March. That's reading it in itself isn't a major deal, but the fact that when you couple it with the fact that only last week the Bank of England were warning about negative growth next year, that really put downward pressure on the British pound. So with that, we saw pound dollar fall to a level last seen. I think it wasn't a 2-year low, but it was quite close to a 2-year low. It was down towards, I think it was a 23-month low. So the low, it's the lowest level since June 2020. So pound dollar didn't get to a 2-year low, but it's not too far away from a 2-year low, a 23-month low. So that itself really speaks to how bearish the market is. Looking here at the looking here at the market indicator, momentum is in negative territory, suggesting the bears are in control. The RSI is moving lower, suggesting the price bias is to the downside. If you continue to hold below these 3 simple moving averages, and we do look to move lower from here, we could target 1.2100, and then 120 will be the next big level to watch out for to the downside. Looking at the RSI, we can see it's moving lower here. If it continues to move lower, it might move into oversold territory. It might do. And keep in mind, when we were in oversold territory here, it lasted for quite some time, but eventually we kind of swung out of oversold territory, and that coincided with a rebound here. So if we do see a rebound in the near term, where can we target? With potentially this area here. If you just put a line in here, we saw there's 1, 2, 3 occasions. This general zone here, just shy of 124, has acted as resistance. So this peak here in around 1.2390, 124, thereabouts, that could act as resistance. If we do clear that, once again, if the metric has been important in the past, it's more likely to be of importance in the future, although there are no guarantees. So if on 3 occasions the market found it difficult to move above 124, there might be a fourth occasion, or who knows, on this, if you do have a snapback from here and it smashes above 124, that 124 area might act as support as the market as it continues to move higher. This is all remains to be seen. But if you do rally from here, I'm looking up towards 1.2390, 1.24. If you do have a break beyond that, the next big level to watch out for will be the highs here of late May in around 1.2637. So I look to wrap things up there in terms of the markets that I've covered. Does anyone have any questions? Any kind of questions in relation to what I've covered so far? Any questions or any markets you want to take a look at and say, hey, David, he didn't cover whatever it is. The NASDAQ went under, for example. Would you mind taking a look at the NASDAQ? And just basically go from there. So we are approaching the end of the update now because I've been speaking now for almost half an hour. Happy hanging around and answer a few questions. It always makes things a bit more interesting when I'm asked questions. Mostly because I often get to kind of look or comment in the market, which I wouldn't typically look at. Obviously, I know I'm going to talk about it in advance of the update, so I have all my my ducks in a row, as it were. I have all my facts and my figures in place. So any questions at all? If there's no questions, that's fine too. I can look to wrap things up. As there's no questions, I'll look to wrap things up. Before I do actually just sign off, what I will show you is my Twitter profile. I'm active on Twitter. I'm on Twitter, all throughout the trading day. My Twitter handle is @dmadden_equity, @DMADDEN_equity. As you can see, you got the equity branding in the background. What I do is I'll be kind of throughout the entire day. I'll be tweeting about what's financial news, tweeting various different headlines that I deem to be important as well. I'll also, once or twice a day, would pick a chart that I find interesting and tweet that. And obviously I can't give advice, but what I can do is provide commentary what's going on. Say this is the overall trend. If the overall trend continues to move higher, for example, look up for levels A and B to the upside, or if the uptrend turns around and moves lower, look out for price points C and D to the downside. So if feel free to follow me on Twitter, feel free to contact me on Twitter, say, hi David, how's it going? What do you make of this? Once again, I can't give investment advice, but I can just provide commentary like I've done in today's webinar. So I'll look to wrap things up there. I do appreciate all of you who managed to hang on here for the full half an hour. I know you probably have better things to do of a Thursday evening, but I will be back here next week. So feel free to sign in then. And if I don't speak to you between now and then on Twitter, I'll speak to you next week. Everyone, have a good evening. See ya.